My name is David. In this module, I will be introducing you to asset depreciation. Let's take a moment to review the simplified acquire to retire asset business process flow, consisting of 6 key steps. These key steps are as follows: additions, adjustments, depreciation, retirement, accounting, and real-time reporting. Let's focus on our third step today, looking at depreciation. Depreciate assets to decrease the value of an asset due to obsolescence or use. Use predefined depreciation methods or create your own custom depreciation methods. Let's review the depreciation methods currently supported. For straight line depreciation, the calculation depreciation program calculates the annual rate by dividing the cost by the life in years. Use this method when depreciation must be spread evenly across the life of the asset. For flat rate depreciation methods, the calculate depreciation program depreciates the asset over time using a fixed rate. Specify either the recovery cost or the recoverable net book value to be used in the calculation. Use this method when the rates for depreciation are decided by statute. For table-based methods, the calculate depreciation program uses a rate table to determine the annual depreciation rate. Use this method when depreciation needs to be accelerated and rates are based on a schedule. For example, use a table-based method when you use the Modified Accelerated Cost Recovery System, or MACRS, to depreciate assets. For formula-based methods, you can define specific formulas to derive annual depreciation rates for your assets. Use this method when any of the predefined methods cannot be used due to special circumstances. For example, a formula-based method may be used when you have a short fiscal year in your tax books. Depreciate the asset cost by actual use or production for each period. Use when the depreciation calculation depends on how much you use the asset rather than the passage of time and basis of depreciation. Also, you can accommodate additional depreciation in the early fiscal years of an asset life using bonus depreciation. You can also limit the amount an asset depreciates by using depreciation ceilings. Let's take a look how depreciation is calculated. Calculated in table-based methods calculate annual depreciation by multiplying the depreciation rate by the recovery cost or net book value as at of the beginning of the fiscal year. Flat rate methods calculate annual depreciation as the depreciation rate multiplied by the recoverable cost or net book value multiplied by the fraction of the year that the asset was held. After calculating the annual depreciation method, asset uses the depreciation calendar and the options chosen for dividing depreciation and depreciating when an asset is placed in service to determine how much of the fiscal year depreciation to allocate to the period for which you ran depreciation. You can choose to allocate depreciation evenly to each of your accounting periods or according to the number of days in each period. Asset allocates the periodic depreciation to the assignment of the depreciation expense account. Run the calculate depreciation process to calculate depreciation for all assets in a book for a period. When you run depreciation, Oracle Assets calculates depreciation expense and adjustments and updates the accumulated and year-to-date depreciation. When you run depreciation, you can either keep the period open after running depreciation, or you can close the current period automatically after running depreciation. If all of your assets depreciate successfully, asset closes the period and opens the next period. Please note, ensure you have entered all transactions for the period before you run final depreciation. Once the process closes the period, you cannot reopen it. Thanks for watching, and please go on to review the 2 videos on how to run depreciation. The next topic in the sequence